Hello everyone, this is Kathy Lien coming to you from the CME NYMEX floor. October was a great month for the US dollar, but as we kick off the month of November, we're starting to see the dollar lose its mojo, as its weakness is pronounced particularly against the British pound. Today, sterling saw its strongest one-day increase, 1.85%, since April of last year. Now, this is an exceptionally strong move for the currency that took it all the way to 130, and it was driven by a number of factors. First and foremost, from the UK, we had a Bank of England monetary policy announcement today, and their decision to keep rates unchanged was not a surprise. But what was a surprise was Bank of England Governor Carney kind of plan or map he provided for Brexit. He talked about the scenarios about how if the UK reached a deal, that we could see a flood of investment capital back into the markets, which could necessitate a rate hike. But what really caught the market off guard was the fact that he said, if there was a no-deal Brexit, there could be a supply shock that leads to an increase in inflation, therefore necessitating a rate hike as well. There were skeptics after those comments, but the fact that he laid out a plan that involved a rate hike for both a no-deal and a deal scenario for Brexit proved to be extraordinarily positive for the British pounds. Now, aside from this factor, sterling was also driven higher by broad-based US dollar weakness. Investors were taking profits on their long dollar positions ahead of Friday's non-farm payrolls report. We had a barrage of softer US economic data today. Chicago PMI came in weaker. Sorry, not Chicago PMI, but the ISM manufacturing index came in weaker. We also had Challenger report 150% increase in layoffs. Now, this is important because it's a non-farm payrolls leading indicator. It is distorted by the fact that Verizon basically offered a voluntary leave plan or staff reduction plan for about 40,000 workers. So that distorted the Challenger layoff report. But overall, there is some concern that even though we should have a post-hurricane rebound in non-farm payrolls, the other components of the report, like the unemployment rate and average hourly earnings, may not be so good. So we did have a broad-based decline in the US dollar. We also had the third consecutive day of recoveries in U.S. stocks. So that basically reflects the improvement in risk appetite, which bolstered risk currencies such as sterling. So there were a number of factors that drove the currency higher today. The question now is, will we see a further gain? Now, of course, if the U.S. jobs report on Friday disappoints, that's going to provide the fire for an additional move higher. There's been a lot of short positions in sterling, so there's still a lot of scope for short covering and extended rally. However, even if we get a good jobs number, I think that the recovery in the dollar will be short-lived, and investors would look at that as an opportunity to buy sterling on dips, because we have seen a very extended move in the greenback, and I think it is due for a correction in the first few weeks of November. Thank you so much. This is Kathy Lien coming to you from the CME NYMEX floor.